Next, let's talk about market structure breaks and trade entries. So market structure breaks can be used to inform trade entries for trades based on the higher time frame structures. In this case, we could look for bearish market structure breaks at resistance for sell or short positions or entries. And we could look for a bullish market structure break at support, long-term support for buy or longs. Often this is used in trades based on multiple time frame setups. Once again, you want to check out our time frame lesson for more information on how to view multiple time frames in conjunction with one another. In this case, we want to use higher time frames to identify the structure or identify support and resistance levels. And within that, we could look for lower time frame market structure breaks to trade or for trade entries based on the higher time frame ideas. And with this, we can start to view the lower time frame market structure breaks. Let's say some sort of market structure break on the hourly or the 4-hourly. We can view this shift in, let's say, maybe if we're in a downtrend, we could view this shift from lower low to maybe sort of a higher low and a higher high in the context of the higher time frames. And that's really what's key when using multiple time frames and using multiple time frame analysis. Viewing the lower time frames for your entries based on what is established in the overall trends and the structure of the higher time frame. Now, within that, this can be scaled up or down as needed. Time frames can be flexible, and I suggest that you are flexible with time frames. You don't have to only use one time frame or only use these two time frames. Different time frames will give you different perspectives on the market. I encourage you to be flexible, especially as you advance as a trader. Maybe in the beginning, you might only want to focus on the daily and the 4-hour and the daily and the hour. That's fine for in the beginning, but as you advance, you want to be flexible with how you're viewing the market, because different lenses, different time frames will reveal different setups and maybe reveal different things in the market and changes in the market environment that you may not necessarily see only on the daily, or you may not necessarily only see if you only trade the 30-minute. Now, it's important to note that identifying breaks in the market structure can be easier said than done. If confirming market structure breaks and shifts in the overall environment and trend changes were easy, everyone would be doing it, right? No one would ever get stuck in a market. Everyone would be buying the bottom and selling the top. That's not the reality. Most people can't do this. Most people lose money and are stuck in positions, right? And this is why trading can be difficult, but identifying breaks in the market structure and general trend changes and changes in the market environment can be very, very beneficial when getting the most out of each one of these market cycles in crypto. Now, within that, most traders end up being their own worst enemy. A lot of them force unwanted trades or unwarranted trades. There's not enough evidence to support them. Maybe they're rushing a market structure break before it's really played out. And maybe generally, I see this most often if we're in a downtrend, right? This really happens most often if we're in a downtrend and, we're seeing these lower lows, lower highs, and some trader will think, oh, I'm going to buy the dip. I'm going to force this trade. This has to be the bottom before seeing confirmation that, hey, there is some sort of sign of a reversal. They're trading against the trend, right? They're longing in a down or in a bear market, and they're forcing some sort of buy of quote unquote the bottom without enough evidence to support that it actually is the bottom. Now, within that, we do want to find some sort of balance between good confirmation, which sometimes could result in a late entry. Let's say price has been coming down and there's some sort of market structure break and we see indications that the market could be turning around. If you wait for all the confirmation in the world to help support, sometimes you might end up with a late entry, right? Sometimes the move already happened or maybe you only catch the tail end of the move. It could have been a 20% recovery in Bitcoin, and maybe you only caught 5 or 8% of it, which is not bad, not necessarily bad, but it is considered a late entry. Now, this is contrasted with no confirmation at all and an early entry, right? Let's say price is coming down and you're hoping that it's going to go up. You're going to catch the bottom and it comes up a little bit. Well, let's say you longed over here. Price could very well just use that as some sort of swing high and pivot way back down and continue its trend to the downside. So that's when you want to find that balance between good confirmation and no confirmation, right? And the balance between a late entry, waiting for all the confirmation, and waiting for no confirmation and entering early. I personally kind of lean towards the good confirmation late entry type. I'm very cautious with my capital. I don't like to take unnecessary risks. But once again, all traders are different. Everyone has a different trading style. The key is proper risk management and knowing what's going on in the market and using that to the best of your ability. Trading market structure breaks. So there's 3 key setups that we want to look out for. The first is a continuation from the market structure level. We'll have diagrams of each of these and more in-depth explanations. But in this case, the trade is in the direction of the market structure break. So let's say price was coming up and there's a bearish market structure break. In this case, there would be a trade in the direction of the market structure break to the downside. The next one would be a continuation from a pullback level. Let's say there's a market structure break, price is coming up, there's a market structure break, it comes down and then it pulls back, but eventually continues to the downside. This is where you would trade in the direction of the market structure break one more time, once again to the downside. Finally, there is the reversal. So this would be trading the opposite of the market structure break. Let's say price is coming up and there's some sort of sign of a reversal. You would trade based off of the reversal of the market structure break. And we'll go over each one of these setups in the following slides. Now, important to note is that all 3 of these rely on a market structure break formation, once again, occurring after a higher high or a lower low has formed. Note, do not force trades based on market structure breaks. Once again, we don't want to just jump the gun. We don't want to, jump on the train before it really has time to play out and confirm. You want to support your idea with other forms of technical analysis. It could be indicators, support and resistance levels, Fibonacci levels, whatever else you like, whatever else you want to use. You want to use those to find what is most likely to happen. Where could price go? And it's important to note that there's no guarantees that market structure breaks will provide a valid setup. The market does not always follow the rules, right? It's easy for us to look back in time and say, oh yeah, look at this chart of Bitcoin in 2021 in November. That was the key sign of a market structure break. In the moment, sometimes it's not always the most obvious that 69K was the top. And that's when it became much more clear when we got to the 50s that, hey, this is looking like a downtrend, and it looks like, hey, there was some sort of market structure break. But at the time of the 60s, it was much harder to tell that. So it's important to understand that there's no guarantees. There's no guarantees that it's always clear in the time of it occurring, and the market doesn't always follow the rules where things are super clear cut and obvious. So let's talk about the first trade entry setup, the continuation from the market structure level. So this occurs after a higher high and a lower low has formed in the general structure. So in a bullish market structure break, this is when price is coming down, and then we see a bullish market structure break, and we see some sort of reversal to the upside. This requires a higher high, where the long trade is taken on the pullback to the broken high. So let's say price is coming down. We have some sort of high, low. We see a higher high. price comes back down to this level, and then it continues upward. We'll have a diagram up in just a second. And a bearish market structure break requires the lower low. This is where a short trade is taken on the pullback to the broken low. And the main idea of this comes from the basic concept of support and resistance, where support turns into resistance when price is falling. Resistance turns into support when the price is rising, right? Let's say Bitcoin's in 30Ks and it breaks past 40K, goes up to 45 and then falls back down. It's rejected at 45 and it comes back down to the downside and it settles. Where is it most likely going to stop? Probably around 40 to 42K. Those are significant levels of resistance on the way up and significant levels of support on the way down. Likewise, if price were to fall from that 45K, fall below 40 and go back to, let's say, 35 or 37K, if Bitcoin were to turn around and go back up, it's probably going to find that 40 to 42K level, a significant level of resistance, right? So support turns into resistance, resistance turns into support, and they're interchangeable. I like to think of them as key pivot points where if price is above it, it could act as support. If price is below it, it acts as resistance. Now within this, the main steps are to identify the market structure. Where are we? Are we in a bullish market structure or bearish market structure? You want to identify if a market structure break can occur or is occurring or has occurred. And then you want to trade based off where the market structure break did actually occur. We also want to keep in mind the point of invalidation. Failing to flip the market structure level, creating support of bullish or creating resistance of bearish, would invalidate the idea, this whole theory of a market structure break. So here's our diagram. Left side here is our bullish market structure break and the retest. So in this instance, we are in a downtrend. We're coming from these lower highs, prices coming down. Price comes down, it produces this low, and it comes up to here and produces this high, right? Another lower high in context of where it's coming from, right? Price was coming from higher, comes down, produces a high. Here we do see price essentially reaching the same level, it fails to produce a lower low. So this is when we could start to think, well, if price is failing to produce another lower low, this could be seen as sell-off pressure weakening, right? Following that, we see a higher high. This once again supports that theory. Selling pressure is weakening because one, it failed to produce a lower low, and two, a higher high was formed, meaning that the bulls are taking control. Their bulls are taking charge. Buying pressure is increasing and is starting to dominate the landscape. We went from a high to a higher high. This is indication of a bullish market structure break, right? We're coming from this downtrend and things are starting to reverse to the upside. Well, let's say price comes back down here. Here we could take a long if price comes back down to here. Long is taken when price fell to previous high, whose break represented the market structure break. So this is our market structure. This is our key level right here, this previous high. Price comes down, breaks past this high to form a higher high, right? And this is all taken in context from this high to the new higher high. If price comes back down to retest this level of where this high was and does not fall below it and actually uses this as support and moves upward, this is a good place to take a long, right? If price were to come down, right? Using our knowledge of market structure, if price is producing a higher high and overall is going to produce a higher low at where the previous high was, it stands reasonable to assume that price could bounce off of here and produce another higher high. And this is where, once again, we want to use other forms of technical analysis. Maybe you want to use an indicator or moving averages, anything else to help support this theory, this knowledge. Now, this is based off a retest. If price failed to to reverse at this level and actually fell below, then this idea is invalidated. On the other side of things, here's our bearish market structure break and the retest. So we're coming from higher lows. Here we're in our bull market. Things are moving up. We establish a low and we come back down to a high. We establish our high and we come back down to a low. We produce another high, maybe a higher high, maybe it's a high at the same level, but ultimately we produce a lower low compared to the low established before, right? This is an indication that selling pressure is increasing, right? And let's say price does retrace back to the upside, price does come back up and fails to produce yet not only a higher high, but fails to produce a high higher than the previous low, right? This is acting as our resistance level. If price comes up and produces a high above that, well, maybe this is not necessarily valid in this case. And in this case, the short could be taken when price rose to the previous low, right? This is our retest. It came back up. This is where our level whose break represented the market structure break. And here we could take a short because it's most likely that, hey, there is a shift in the market structure. It's more likely that price is going to go down. Now, trading market structures and the continuation from pullbacks. To reiterate, bullish market structure requires higher highs and higher lows, and a bearish market structure requires lower highs and lower lows, right? We want this concept of higher highs and higher lows in the bullish market structure. The bearish market structure, we see price descending, lower highs, lower lows. A bullish market structure break needs a higher high. The continuation trade is taken below the breakout point, but above the most recent low. And in a bearish market structure break, this is where we need the lower low. The continuation trade is taken above the breakout point, but below the most recent high. So here's our bullish example. Let's say a bullish market structure break is identified. We see a higher high and a higher low formed. The next higher high is formed, meaning that if the market is in fact bullish, the next dip will form a higher low, right? This is the assumption of, hey, we're in a bull market or a bullish market structure. We're assuming that the next dip or the next low will form a higher low. Which area or level, which isn't the breakout level, could be where the higher low is formed? And that's really where the question is. And this is where you start to use other indications and other means of analysis to support your theory. So price forming a higher high and not just going straight up isn't always bearish. Pullbacks are common in bullish market structure as long as it forms a higher low. So let's say we had our downtrend, right? We have our downtrend. We form a high, we form a higher low, we form another high. Let's say this is our previous high, right? Price came up to here. If price pulls back, right? If price pulls back, that's fine as long as it forms that higher low in context and in comparison to the low before it, right? We want to see the higher highs and higher lows. That is really what makes up that bullish market structure. And we'll see an example of this in just a little bit. Now, in this situation, price could do four things realistically. In a very bullish situation, it could produce a higher high and keep going up where there's no pullback, right? There is no pullback at all. In a bullish situation, it produces a higher high, it retests the breakout level, forms a higher low, and continues upward. This is the last example that we just looked at, the first example. That is this situation where price came up, produces the higher high, it comes back down to that breakout level, it doesn't fall below it, it forms a new low, and then continues upward. Sometimes price just keeps going up, and that's where the bullish, very bullish situation comes, right? Price just, it doesn't retest that breakout level, and that's fine too, right? But taking a chance that it's not going to retest and entering at that bottom is considered risky, and we'll see an example of that in a little bit. Here's another bullish situation. Let's say we see some sort of low, we see a high, another low, we see a higher high, a dip below that breakout level, right? In the first situation that we saw before, we saw the retest at that breakout level and it formed the higher low. In this second situation, we see the dip below the breakout level. It still forms a higher low, although it's below that breakout level, and it continues upward. So this still falls into the category of a bullish market structure break, because generally the prices are going up, even if the higher low was not at the breakout level. And then we have our fourth situation, which is a caution scenario. We have our higher high, dips below breakout, falls below the previous low, forms a lower low after the higher high. And this is where we see another market structure break. Or in this case, let's say if price was coming down, we see the signs of some sort of market structure break to the upside, and then we see another structure break to the downside, right? So this is something that could happen, and this is something that we can consider like some sort of market fake out, where the market was giving signs that it was going to reverse, but it actually didn't. So here's our diagram for this second example with the bullish market structure break and the pullback. So we're coming from these higher prices, lower highs, lower lows. Price forms a low. It comes up to this high, right? Here we see another low observed. And this is where the beginning of our market structure break occurs, because from here, price, even if price did produce a lower low, that's fine as well. What's important is that price produced a higher high. This is an indication that buying power is increasing, and it's a shift in the market structure, the break in the market structure, right? And where we see this new high, from a high to a higher high established. Price comes back down. Now in our first example, price could have come to here, established the low, and continue upwards. In the very bullish situation, price could have established this low and just kept going, right? That's one thing that could happen too, with no pullback at all. In this situation, price comes back down to the breakout line, to the previous high, and falls below it. Now, this could still be considered a bullish market structure break, because the idea is still valid as long as the previous low is not broken. If the previous low is broken and price falls below that, then the higher high and the lower low structure is invalidated, right? This entire structure is invalidated. The higher high and higher low area is invalidated. So realistically, this whole area could be our higher low area, right? Price could stop here and still be valid. Price could stop here and still be valid. Price could stop right here, maybe even $1 or so above this, right? And still be valid. The key is that this previous low is not broken. Here we see the reverse, where we have our bearish market structure break and a pullback. Price is coming from lows and it's moving higher. Here we see a high. We see a low established here. Another high. This could be equivalent to here, or maybe a new high. Price falls. Price does not produce a higher low. Price falls. Therefore, this is a sign of a market structure break, right? Because in a bullish market, we want to see those ascending highs, those ascending lows. By producing a lower low, this is our market structure break, and this originated from this high. Now, price could really bearish, just keep going down. It could come back to this breakout line and then go down, as we saw in our first example, or it could retrace and pull back to some sort of high in this area. Now, as long as price does not surpass this high, this previous high, then this is still valid. If price goes above this, then this bearish market structure break is invalidated, and then we would see a continuation of the bullish market structure, right? But price could come to anywhere in this area and reverse and then continue to the downside. Now, pullbacks. So a pullback generally is when price is trending in a direction. Let's say price is moving upwards. We're seeing higher highs, higher lows. Price is trending in this direction. It goes in the opposite direction. We see some sort of dip or reversal or pullback, but generally the overall structure is valid, right? We're seeing this bearish, bullish market structure where anything below the breakout level but above the last low is valid, as we saw in the previous example. And in our bearish example, anything above the breakout level but below the last high is still valid. Now, the question is, where could price go? We're looking for possible higher lows or lower high areas. This could involve using support and resistance levels, higher time frame candle opens, closes, or wicks. Moving averages is another tool that you could use, Fibonacci levels, and more. There's really no one answer as to planning out or charting out where price could go from these levels. It really depends on what you're looking for and what you use. Another thing to consider from a trading perspective is your risk to reward ratio and considerations for that. The farther the pullback, the superior the risk to reward. Deeper pullbacks are closer to invalidation levels. And remember, the invalidation is a lower low in a bullish market structure and a higher high in a bearish market structure. So think of those breakout lines. Let's say in a bullish one, price comes back down. If price is coming really low to that lower low and you enter the trade, it's much easier to set a stop loss at that lower low that you want to avoid and take a small hit, right? Because it's so close. If price doesn't really come back and you still set your stop loss for that lower low, you could theoretically take a much bigger hit if price does come back down, right? But if you do see that price is coming down and you wait for confirmation that, hey, that actually was the bottom, that would give you a much superior risk to reward ratio and a safer entry. And the same thing with to the downside, but in reverse. So here's an example of Solana. This is a recent example, Solana on the 4-hour chart. Here is an example of using moving averages to determine, hey, where could price go in the event of a market structure break. So in this example, we see Solana coming from a downtrend, producing lower high, lower low, lower high, and lower lows. Just generally, prices are coming down. Here we have the moving average, the 50 line in the blue color, and the moving average 200 line in the bluish green, this lighter color. So this is our 200 moving average, 200 period moving average, and the 50 period. Overall, we do see the beginnings of what could be a market structure break, a bullish market structure break, where we see our high, we see our low, we see arguably a higher high, and then a higher low, depending on what you're looking at. This could be our swing low. This could be it. This could be it as well. Generally, this whole area produced a higher low compared to there. So this could be considered a market structure break, and we do see a higher high established here, right? This is our breakout line, right? And price surpassed that. Price surpassed this level of about $105 and came to about a high of about 111. Now, price does come back down and retraces. Now, the question is, all right, so in order to invalidate this idea, price would have to fall below this higher low or this most recent low. Price would have to fall down here. But it doesn't, right? Now, the question is, if price doesn't fall down to this level and it falls below this breakout line established here, where could price go? Well, if we're using moving averages and we see on the moving average, the 50 period basically wrapped around here and gave us an indication that said, hey, well, the $100 area was the current 50 period moving average at that time. That was the current reading, and price actually used that as support. This was actually a great entry if someone was using this technique, waiting for a market structure break, at least on the 4-hour anyway. So we saw price come up, produce this higher high. It comes down to here. This could have been a great long entry. And let's say we entered here because price failed to produce another lower low, right? It continued with this market structure break, so it was safe to make a long trade in this situation. Price did reverse to the upside, and the question could be, all right, well, we're in this trend. Where could price go to next? And as we saw, price actually met to the moving average 200 moving average, and saw that as a form of resistance. Price failed to meaningfully surpass this. So if we entered a trade from here from about $100 and exited about 120, you just made 20% in, let's say, a couple of days, maybe from February 5th to February 8th or 9th. So really in about 3-4 days, you could have made 20% on a Solana trade using this strategy and using this technique. Next up, let's talk about trading market structure breaks and reversals. So the two setups shown above focused on taking trades in the direction of a market structure break, where it acted as a continuation of where it was going. Setup focused on retest of the breakout level, and setup 2 focused on pullbacks from the breakout level, where the price actually breached past that breakout level, but failed to breach past that lower high or that higher lower high or lower low, depending on the situation. Now, reversal setups focus on trading in the opposite direction of a market structure break. In this situation, you would long when a lower high fails to form after a lower low, and you would short when a higher low fails to form after a higher high. Now, it's important to know that good setups that fail can be great setups in the opposite direction. So if you see a market structure forming, a market structure break forming, and it fails, let's say, you're hoping that you're looking for a bullish market structure break at the bottom, and price comes up and forms a higher high, but it fails to form a higher low, right? That low comes even lower than the previous low before it. Well, that's a great opportunity to short and to create a setup in the opposite direction. So a higher high is bullish, a lower low is bearish. Our bullish invalidation is a failure to produce a higher low, and a lower low is formed that invalidates any bullish market structure or bullish market sentiment and gives more credence to bears, to shorting. Likewise, a bearish invalidation is the failure to produce a lower high or produce those lower prices. In this case, a higher high is formed that gives credence to bullish buying power and bullish market structure. The main idea is that market structure breaks, or the market structure break, failed to offer continuation of direction. This suggests that a reversal could be possible. So here is our two different scenarios. On the left side, our bullish situation where we see a failure of the bearish market structure break. So let's say price is coming from this area, from lows. It's coming from highs, and it's producing consecutive higher high, lower highs, lower lows. We see a low formed here, and it comes up to this high. This is our high before the market structure break. We don't know any of this is happening yet, but this is our high. Price forms a lower low, comes up, forms a lower high, but then fails to produce yet another lower low. It forms this higher low, and then from here, price comes up and produces a higher high. So this is our invalidation of this bearish market structure. An overall bearish market structure break. Price comes back down to here. It uses this as support and does not breach this high before the market structure break. And generally it closes above the market structure break high and uses this as support. So this is a bullish setup, another bullish setup. Another thing to keep in mind when looking for these market structure breaks are failures. In this situation, here is our bearish setup. This is a bullish market structure break. So we see here is our bullish market structure. We're coming from lower prices. We produced this high. We produced this low. This is our low before the market structure break. We produce the higher high. Price comes up. Price comes down. Produces a higher low. Fails to produce a higher high. In this situation, following this lower high in this situation relative to the high before it, price falls and falls below the low formed before the market structure breaks. So price falls below this low, and this is when the bulls would be in trouble and should show a reason for concern. A lower low being formed, especially such a drastic low that was lower before these lows observed. Price comes up, attempts to break past this low and fails to do so. And from this high, this once again another a lower high and a consecutive lower high, price would continue to fall. And this is where we see the close below the market structure low, market structure break low, and this acts as resistance. So here are some final considerations on trading market structure breaks. Now, in terms of time frame, expect the time frame of the market structure break to have significant impact on the size of the move that comes after. So in this case, the daily market structure break is a larger and longer setup and a larger and longer pattern compared to a 15-minute market structure break, which is a shorter and smaller pattern. It's going to happen faster. Remember, each one of those candles is 15 minutes compared to in a daily setup where each one of those candles is a single day. Now, one thing to be aware of is the fact that lower time frame market structure breaks at higher time frame levels could lead to higher time frame market structure breaks. These could be the beginnings of a significant change or shift in the market, and you'll see them earlier on the lower time frames compared to the higher time frames, and it really depends on their significance. We don't know how significant they'll be, but if they do occur on at significant higher time frame levels, that could give credence to them that they will in turn affect those higher time frames, and that it could lead to those higher time frame shifts as well. Now, contrary to that, in a sense, lower time frame market structure breaks do not cancel a higher time frame dominant trend, right? Only a higher time frame market structure break can significantly impact a dominant trend, a higher time frame dominant trend. Once again, you want to trade with the greater trend or the market environment, i.e. long in a bull market or short in a bear market. And you want to view lower time frames in the context of the higher time frames. In this case, the lower time frame bearish market structure and a high time frame bullish market structure could be a dip buying opportunity, and a lower time frame bullish market structure and a higher time frame bear market structure could be a short the rally opportunity. So let's say there's some sort of bullish market structure on the 1 hour, but the higher time frame daily is really down. It's a bear market. It's a downtrend. That could be an opportunity to short the peaks of those lower time frames, especially if they are not at higher time frame levels. We also want to consider volatility and volume. So low volatility market conditions will produce less obvious or smaller market structure breaks. A commonly used phrase by traders is for low volatility markets, or really low volume markets, is called chop. It's a phrase used to describe periods of extremely low volatility where prices moving in a tight range that can be difficult to read or trade. Sometimes you'll see this in Bitcoin, where Bitcoin just really enters some sort of pattern that's really tight, and there's no fluctuations. We traders, we love volatility. We want to see movement in the market up and down. That way we can get in, get out, get in, get out, get in, get out, depending on if you're long or you're shorting. If the market is moving in a super tight range and it's hard to really read where it's going next, that's considered low volatility, and that's the market that we don't necessarily want to trade. Typically, you'll find low quality trade opportunities in those types of environments. Also, you want to focus on market structure breaks at the extremities of the range rather than chase every higher high or lower low in the middle of the range. Yeah, you want to look at the bigger picture, right? Really take in context what is going on in the market, not just a specific part of the range. You want to look at the extreme highs and the extreme lows. For one example could be a bearish market structure at the top of the range and a bullish market structure break at the bottom of the range. And within that, you really don't want to force a trade or force any viewpoints when market structure break trading, right? You want to let it occur, let it form, let it be obvious. Don't try to force a trade. Don't try to force your viewpoint of what you think should be a bottom or what you think should be a top. Let it come to you. Let it be obvious.